If the silver is, somewhere below 30, I'm pretty much out. If the gold, I'm favorable. I'll be more lenient if the gold makes up a portion of the deposit and helps bring the gold silver value to somewhere close to 40%. I still want to see more silver than gold. But yeah, I mean these things are a rarity, and so I think that they're going to really drive a premium at some point in the market.
The silver market is struggling to sustain a strong bullish trend, as prices have yet to break above the key resistance level of $31 an ounce. However, silver has still posted impressive annual gains of over 12%. Historically, as risk premiums stabilize, precious metals tend to outperform, with silver often leading the way. According to the 2025 LBMA Annual Precious Metals Forecast Survey results, precious metals prices could be in for another standout year, while silver prices could top $43.50. PeterKrauth, a renowned precious metals analyst, highlighted the potential for a silver bull market driven by inflation, rising interest rates, and the impact of tariffs. Examining the silver market, he noted that futures spreads, both short and long term, suggest that the market is pricing in higher silver prices ahead. As the author of The Great Silver Bull and a publisher of newsletters on silver investing, Krauth sees striking parallels between today's economic climate and the 1970s, when silver prices surged amid soaring inflation. He believes similar conditions could set the stage for another major rally in silver. In other news, President Trump proposed universal tariffs that are much bigger than 2.5%, a global starting point reportedly favored by U.S. Treasury Secretary Bessent. The tariffs are meant to reshape U.S. supply chains and protect our country, said Trump. The U.S. dollar strengthened on Trump's latest proclamations. Krauth highlighted the impact of the Trump tariff threat on the silver market, which has been influencing trader behavior since December. With uncertainty surrounding potential tariffs, those with silver obligations in the U.S. have been scrambling to secure physical metal. Join us as we dive into the video for a deeper look. Don't forget to subscribe and click the bell icon to stay informed about our latest updates.
David, you've probably seen the 10-year yield is way up, and it's up in the face of so it's up about 100 basis points in the face of a 100 basis point rate cut by the Fed, which is something we've never seen before. And you alluded to the bond vigilantes, and they're basically telling us that they think that the market thinks that the Fed is wrong, and it should not be cutting rates. At least it should probably be holding rates. And it basically is providing juice to the economy that the economy doesn't really need right now. And so by rates going up in the face, sorry, 10-year yields going up in the face of rate cuts, the bond traders are basically telling us that they do see higher inflation coming. And I really think that the Fed's, got a major dilemma. It's either going to stop cutting to help fight inflation. We know that's going to worsen the debt because the government, its interest payments on debt are through the roof, becoming the single biggest line item in their budget. It's not good for Wall Street. It's not good for Main Street, or they're going to ultimately continue cutting rates. That'll make the government's, budget situation a little bit easier to digest. That's going to juice the economy further. It's going to make more room for them to eventually hike rates in the future. We'll see how long that takes, but it's obvious that's going to lead to more inflation. So, to me, it's obvious the path of least resistance is the second option to, eventually keep cutting rates. They can say that they don't pay attention to the government's budget issues in terms of what it faces with high rates, because obviously it becomes unsustainable. But I don't believe that they don't take that into account. So that's kind of my sort of quick view on the macro side, and on the sort of more immediate side with silver. One of the things that we've seen happening, and I've been following pretty closely, is the Trump tariff threat, which we've seen traders start to act on going back probably, I'm going to say, since December. So, there's no clarity, there's no certainty, and that leads to volatility for sure. But, anyone who has an obligation with silver in the US is looking at needing to, is looking at trying to get its hand on the physical silver for if they happen to have to make a delivery. So we've seen quite a bit of metal flow out of London. So these are what we call exchange of futures for physical premiums. So they're exchanging their futures for physical. The premiums have gone up. They've been scrambling to get the metal into the US to avoid tariffs. Um, Again, we don't know if or when they will come, but if they do, it's looking like odds are pretty high that unless he makes an exception, that gold and silver would be affected by that. So we've seen the metal flowing in. That's hurting, inventories in London that have really gotten quite tight. We've seen actually inventories go up in the COMEX and in Shanghai. We've also seen deliveries go up on the COMEX. So, the metals moved to New York, but then participants have also been taking delivery. So that's really narrowed the number of ounces that are available for delivery. And what we've seen too is if you look at both short and long-term futures, the spreads of futures versus spot indicate that the market is seeing higher prices coming. So, I mean, this is what I've been watching.
According to the Silver Institute, the global silver deficit is expected to decline by 4% to 182 million ounces in 2024, as supply rises by 2% while demand grows by 1%. Industrial demand is projected to hit a record 1.21 billion ounces, driven by increased jewelry consumption and expanding electronics use, despite a 16% drop in physical investment. Supply growth is being supported by a 1% uptick in mine production from Mexico, Chile, and the U.S., while silver recycling is anticipated to rise by 5% due to increased Western silverware scrap. With silver prices up 32% year-to-date, exchange-traded products, ETPs, are seeing their first annual inflows in 3 years, signaling improved investor sentiment. PeterKrauth believes the silver market is pointing to higher prices, as futures spreads indicate. He emphasized that the market remains in a substantial supply deficit despite evolving buying patterns. This persistent shortfall, he said, strengthens the long-term bullish outlook for silver. Now, let's redirect our attention to a video.
We talked about inflation early on, and I would say that's probably the main thing you want to point to because, they could talk all they want about cutting expenditures, and I mean, there's just such a small dent only that they could possibly make. Musk has already backtracked on his $2 trillion cut. That's going to likely be closer to 1 trillion, and he hasn't even gotten started yet. So I think, if anything, that's what this new administration will do. Like David said at the beginning, I don't see it making a difference who's in office. This is well beyond anything that we can we can reverse at this point. When it comes to crypto, sure, he's positive on crypto. What can that do? Well, potentially, sort of short term attract hot money if something particular comes along or whatever it may be. But beyond that, I was looking at some numbers comparing the Silver Institute's forecasts back in April when they put out their World Silver Survey, and then I looked at the comparison with when they put out their updates back in November, which is, you would assume, more real time or more realistic for 2024 because they're closer to the end of the year. And so what I found interesting was that they thought that physical investment, they revised it downwards, and that revised the market balance downwards. In other words, it was going to be a smaller deficit by, I think, about maybe 30 million ounces. Not huge. So let's say from, I think, about 215 million ounce deficit to 182 million ounce deficit. But still, it's according to them less of a deficit because of they expected lower physical investment. However, they have a separate line item that is net investment into ETPs or ETFs, which we know silver ETFs more commonly as, and that actually doubled from 50 million ounces flowing into silver ETFs to 100 million ounces flowing into silver ETFs. And we've started to see that. If you look at a chart of SLV, the silver ounces held by SLV bottomed in about July of last year and have been trending very steadily upwards. We see, people are buying it. The ounces are flowing into that. And you know, the interesting thing is if you include, so they show it separately, but if you look at the very bottom line where they show market balance, including flows into ETFs, you actually have forecast for 2024. So, we're going to probably find out in the next sort of month or two. Um, that ultimate deficit for the year is going to be the second highest deficit on record, 282 million ounces versus 2020's 300 million ounces. Second highest record deficit. So, the money may not be going into physical or not as much, but it's going into silver investments that are, let's say, versions of physical, if you want to call it that. And maybe a little bit, if I may, a little bit of color on kind of what I'm hearing anecdotally, is that the bullion dealers, not all, but many are really seeing that. They're seeing that their sales of physical has gone down a lot. They're admitting that they're buying a lot more silverback than they're selling. Um, but at the same time, it looks like the sales are happening through Costco and Walmart. Costco has said that they're at a pace for about $1.2 billion of gold and silver sales per year. Walmart, I haven't heard. Dealers are potentially buying from Costco and Walmart because the margins are so low and then reselling. So, it may just be that the demand has shifted from, one source to another, and perhaps it has lessened as well because the markets, have been maybe less exciting. Both metals have done well, but sentiment is still not great. We know that. So the physical buying looks like it has trailed off somewhat or shifted, to suppliers that are a lot more concentrated, and some of the buying is looks like it has also shifted to the ETF world. So, but if you look at, like I say, at that ultimate market balance, I think that's really the number that we need to look at, and it's really quite telling about the state of the silver market.
Silver's appeal as an investment is well established, serving as both an inflation hedge and a low correlation asset. In 2024, it ranked among the top performing commodities, delivering a 20.58% return. Rising demand led to a physical deficit for the fourth consecutive year, briefly driving prices to $35, the highest level since 2012. With silver maintaining a physical deficit for 4 straight years, how does this impact long-term prices? Drop your comments below and let us know what you think. If you found this video helpful, please like it and subscribe for more. We're grateful to have you with us on this journey.